YouTubers, Mike Martin's here. Mike Martin's channel. And let me see if this damn thing's recording. Yes, it is. Anyways, the exuberance. What does exuberance mean if you're living in the West? The excitement. And how the Royal Commission will knock the exuberance right out of the Australia's property market. This was just sent to me via Facebook. Guys, if you want to send me something, please send it. Follow me on Instagram. Just type in my name, you'll find me. And it's the official one, because there's like 2 fake ones. And I really, really recommend you guys take a look at this article. I'll leave a link below, because it is a really long article. There is a video up top, which I recommend you guys to see. Because what's been happening here, let's read a little bit of this so you guys can understand what I'm saying here. How the Royal Commission will knock out the exuberance right out of Australians' property market. This weekend, more than 1 in 5 home buyers will blow their self-imposed budget and probably regret how much they spent on their new property. Why are they spending more than they can afford? Well, the fear of being bought out. They'll fall in love with the place, get caught in a bidding war and underestimate the market, or perhaps lose their patience after a long hunt. Yeah, it's been happening. But the ability of people to outspend their better judgment on a house is now directly at stake due to the questions raised by the Banking Royal Commission. A growing chorus of big-name economists believe that could have significant implications for house prices. Specifically, 22% of home buyers admits blowing their budget at auction, according to the study of 1,000 property buyers conducted by ME Bank and released exclusively to Domain, with 1 in 10 in that group belligerently handling over upwards 150 large than they originally set out to spend. So $150,000, guys, at 1% is going to cost you roughly per year about $13,500 in finance charges. $8,000 depending on the rate. About $8,000 to $13,000 in finance charges on $100,000. So if the rates are super low like they were, you're looking at anywhere from $2,600 to $3,500 a year in finance charges. But when people's budgets go over $100 a month, they're screwed. We think that the Royal Commission is likely to recommend greater due diligence required for banks to comply with responsible lending laws. Now, this is the whole point of the article right here. Those buyers were able to walk away with the keys to their new home despite overshooting their targets by a fortune, because their personal budget is often much lower than set by the bank. Some of the people most talked about the Royal Commission, most of the first-round public hearings focused on major banks' inability to capture the clear image of their customers' living expenses, which is why they would often lend more than what was appropriated. So, guys, I have been talking about this, your total debt service ratio, your LTV, your loan to value. And what's been happening with the total debt service ratio for people is they have been borrowing more than what they can afford. So a lot of banks have been fudging numbers and putting a lot of junk on the books. And you know what? I really don't blame the lender, because they have all these, oh, I got this commission, I got quotas to hit, I got to hit quotas when all my other co-workers are hitting quotas, and I'm not. I'm going to have to fudge the numbers. I could walk into one of these banks as an auditor, start looking through their mortgage files. I'll start seeing, why is there only 1 piece of ID on file when it requires 2? Why is this guy's pay stub 2 years old? Did you call to verify employment? Where's the notes? Oh, I could go in there as an auditor and start filing through piece by piece. Why is his yearly statement employment? Why is there no gross? What is this? Is this on commission only? If it's on commission only, we need to divide it by 52 weeks commission only, and then only use half of commission. You know, things like that. Going into, why is this TDS 66%? When the loan-to-value is 109%, why did the loan-to-value go over what the property was valued? Well, sir, we were going to look into the fact that hopefully that the housing prices were going to go year over year 20% over value. No, you see, that's where people get things wrong, and that's when a lot of lenders think they're helping the customers. Because a lot of lenders believe they're helping customers, but they're not helping customers. I could walk in there and start looking at everything. If they hired me to look at as a forensic, like look through the files, look at gaps on credit scores. Why does this guy have a gap on his credit score? He filed for bankruptcy. Why is he getting this loan? Anyway, my man Mike. So that's what I'm trying to say to you guys. So let's keep going. The cost of cleaning up the system. The UBS economists George Darno and Carlos Cacho reiterated, it must be remembered that the house prices are determined by the demand and supply of credits, not the demand and supply of housing. That's a good point, but it's very arguable. With that in mind, the economists paint a dark picture of the next phase of Sydney and Melbourne property cycle, arguing the mortgage borrowing limits could fall about 35% if the book is thrown at the lenders. In absence of reliable customer service living expense information, big banks have referred to the benchmark indicator, the housing expenditure measure, to indicate reasonable lending limit. The UBS argues that indication underestimates real living expenses, with the basic benchmark assuming a family of 4 is living in the expense of about 32 large per year, while the lavish annual expenditure for a family of 4 would be 58 large. In a Commissioner Kenneth Hayne recommends applying stricter rules on mortgage lending and diligence, those benchmark indicators could look quite different. And that would mean lending limits fall materially according to the USB. Now, guys, so I'm going to leave a link below to this. I want to explain something to you. When you go to the bank, you bring in your pay stubs, you bring your notice of assessment, whatever you call it down in Australia. You bring in your IDs. You bring in everything to do this deal. You start looking at what you qualify for through your credit score. Okay, fine. If the bank denies you, they are helping you. If the bank says, no, you don't qualify for this mortgage, guess what? They just saved you a headache. Believe me. But now the banks have gotten soft. They started putting garbage on the books. The underwriters know when a good underwriter looks at a deal, looks at the credit score, never mind his credit history, but what he makes, what his loan to value is in the house, what his TDS, total debt service ratio. A good underwriter will look at a loan and say, this loan is garbage and it's going to fall apart in 3 months. Because how is he eating? Off friggin' credit cards? Anyways, like I said, if I was to go to do some forensic review on some of these mortgage files, I'll find 5-6 problems. And they have been refunding people. I'm going to leave a link below. Some people have been getting refunds. The link, I'll leave a link below to this because this is a good one. Watch the video, okay, with Miss Rowan Orr, and she's talking about this, how people finding garbage on the books, taking their stuff to lawyers and saying, oh, they couldn't do this deal because your ID doesn't match your pay stub or this, that. They'll find things to flag the deal and get a refund back. Because if the bank is at cause of creating these problems, they should be at fault, because they should not be putting garbage on the books, because what's going to happen is going to come back and bite them in the butt like it is right now. So lenders, be honest. If a person doesn't qualify, don't lie on their TDS. Do not lie on their income, because you're not doing them a favor. Thanks for watching, guys. Let me know in your comments below.